Lyft is finally expanding beyond North America. They added Canada recently, and now they're moving into Europe with an acquisition, about $175 million to get into basically a taxi business. It's a little bit different than what Lyft or Uber typically does in the US or around the world, connecting individual drivers to individual riders. But this is potentially a transformative acquisition for the company, especially as we move into autonomy. So I want to go through exactly what was announced today, what we know about this acquisition. I think it's pretty low risk. They're going to be able to fund this with the cash that's on the balance sheet, but it does give a lot of opportunity for growth. And the framing that I want investors to look at this with is as we move into an autonomous world, Lyft and Uber, they're going to be dealing with more fleet operators. So they're not going to be dealing with necessarily individuals who are going to own vehicles. They're going to be dealing with companies that own 10, 20, 50 vehicles, and they're operating that fleet. And then Lyft's job is going to be managing the fleet and providing services to those fleet owners. So things like cleaning and charging, and then also the marketplace that they typically operate today that you actually know the company for. With that in mind, this is potentially a really interesting acquisition because it gets the company into Europe, but in a way that's built for the future, not necessarily the way that's built for the ride-sharing world of the past. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's dig right into the press release today. Lyft expands in Europe, diversifies by acquiring FreeNow. If you're not familiar with FreeNow, which I was not until today, it is a taxi app service. Basically, 90% of their rides are through taxi services, not through individual rides like you would see with something like Uber or Lyft that we have in the US. So a little bit of a different business model, but it allows you to book a taxi fast. And they're a pretty big operator in, I think it's 9 countries in Europe. It says here 50 airports. So pretty big presence across Europe. I also want to note that not much of a reaction from the market today. Stock's actually down a little bit. So clearly investors don't think this is a huge deal, but I think this is the kind of asymmetric potential that we want to see from Lyft. So the details are right here, 175 million. I think it said $175 million. It's actually 175 million euros, $197 million. That's as of today's conversion rate. So they operate in the UK, Germany, Greece, Spain, Italy, Poland, France, and Austria. Transaction is expected to close in the second half of this year. And here's really the strategic move. Approximately 50% of bookings in Europe are still happening offline, but customers are hungry for more online bookings. So that's where FreeNow really fits into the market. Approximately 90% of FreeNow's gross bookings come from the taxi business. So Lyft is going to be able to integrate some of their technology, some of their services, just gives more operating leverage to a lot of the things that they're already developing, but not a whole lot is going to change, at least for the near future. There's going to be no immediate changes for FreeNow's customer experience. Over time, new benefits will be made available for FreeNow drivers and riders. And then the companies are going to focus on integrating riders seamlessly, whether they're using the app across the Atlantic or North America or Europe. So it'd be interesting to see if there's just a name change or if we're still going to be using the FreeNow app. But where this is important for Lyft is it's very low risk. Let's start with the company's balance sheet. You can see right here that there's almost $2 billion worth of cash on the balance sheet. There is a little bit of debt, so nearly $1 billion worth of debt. So that net cash balance is about $1 billion. They are going to pay back some of that debt. They also have a stock buyback plan. So there's a lot of options for their cash, and they are continuing to generate cash flow as well. Now, these are trailing 12-month numbers, and there is some wonkiness in here because there's warranty expenses. So there's kind of some fluctuations in some of their costs. That was a tailwind over the past couple of months or a couple of quarters. But I think it's pretty solid to say that Lyft is going to be free cash flow positive going forward. So a $200 million acquisition to get into a major market like Europe, I think that's the right kind of move. But strategically, we have to look at this with the idea that this is going to be more of an autonomous driving company in the future. And I think that's where I'm maybe thinking about this a little bit different than most of the market. One of the reasons that I'm interested in Lyft, it is the number 2 player in the US in particular. Uber is the big game in town. There's another stock that I own. So I own both of these companies in a basket. But the upside for Lyft is that they become a company that can make a faster and easier transition to autonomy than Uber can. If you just think about their business, if you look at your Lyft app, there's likely fewer drivers on Lyft right now than there is on the Uber app. That's just the way this works. This is a supply-driven business, and Uber has more supply, therefore Uber has more demand. That's allowed them to expand into a whole bunch of other businesses like food delivery, and those things all work together to make their business much bigger and more valuable. So Lyft is this smaller second player. But now think about the future of autonomy. If Lyft wants to go all in on autonomy, pick any city, they're going to launch an autonomous driving service. And you could say, you know what, we're going to launch 1,000, 2,000, 3,000 vehicles in that city in a single day. that's going to change the supply dynamic in ride sharing. And if they say, you know what, we're able to just push away our human drivers and put less focus on them. Remember, Uber is going to have far more human drivers that they're going to have to think about as they push into autonomy. Lyft can basically burn the boats. So they can say we're going fully autonomous and we're going to lower our prices. So we're going to have a supply advantage in the market and we're going to have a cost advantage in the market, or a pricing advantage. That's really the upside for Lyft. But then again, you have to think about what the supply for that autonomous market looks like.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
Lyft is not going to be the owner of autonomous vehicles. They are going to work with other suppliers. So they're going to work with companies like maybe Waymo or Zoox or May Mobility. They're working with Mobileye. They have a whole bunch of partnerships that I think we'll hear announced over the next couple of years as more and more companies get approved to do fully autonomous driving. So there's going to be that level of partnerships. And then who's going to own the vehicles? I don't think it's going to be individual owners the way that it was during the traditional ride sharing business. It's going to be more fleet owners, somebody that owns a dozen or a few dozen vehicles. So if you own 20 autonomous vehicles and you're just hooking them up to the Lyft network, that relationship is going to be much more like a taxi fleet relationship than it is for a traditional Lyft or Uber relationship. That's where I think this deal ultimately probably makes the most sense. Working with taxi companies and taxi fleet operators is going to be much more similar to working with the future of autonomy fleet operators than it is the current Uber and Lyft market. So this maybe isn't quite as crazy as it seems on the surface. It seems a little bit weird that Lyft is getting into a taxi app business, but that's probably what the future of autonomous driving looks like. And I think that's ultimately the 10x or maybe even 100x potential for Lyft. Remember, this is a company that just has a market cap of $4.5 billion today. Uber has a market cap of $155 billion. So Uber is 35 times bigger than Lyft right now from a market cap perspective. I think autonomy and the expansion of supply of autonomous vehicles and the likelihood that these marketplaces, these companies that are offering the connective tissue between supply and demand, the opportunity for them is going to be 10 times bigger than it is today, at least. If they can go from being 1/35th the value of Uber to being 1/5 the value of Uber, and the market gets 10 times bigger, that's how you get that asymmetric potential. So that's why I think this is so interesting. This gives Lyft a presence in the United States, Canada, and now Europe. We'll see if they continue on an international expansion. But this is pretty low risk given the fact that it's with cash that they already have on the balance sheet. They don't have to issue stock. It's not a crazy expensive acquisition, just one that tucks in nicely with their strategic options. And I think this is another sign that they're taking autonomy very, very seriously. Quietly, Lyft is making very shrewd moves to be, I think, a leader in the future of autonomous vehicles. But let me know what you think about that strategy in this recent acquisition. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.